Hello, chart watchers, and welcome to this Tuesday, March 5th, 2019 Market Watchers Live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. All right, well, we've got the market still trying to stabilize after a more volatile day yesterday. You can see the Dow Jones Industrial Average currently up 1 point, the S&P 500 down 1 point, the NASDAQ up almost 9 points, and the Russell 2000 down 2 points. So all the major indices hovering near that flat line. 10-year Treasury yield is bouncing back up a bit today. You can see up almost 2 basis points, 2.74%. Volatility remains below that 20-day moving average. We had a huge breakout intraday yesterday, but we did come back down as the market tried to rally a bit yesterday afternoon. Among sectors, consumer discretionary stocks leading to the upside here, but being chased up by the real estate group. Both of these sectors, the XLY, XLRE, both having nice days today. Companies in the news for earnings, number of them doing very well. Kohl's Corp, you can see up more than 7% today. Target up almost 5% today. Both of them doing very well and clearing prior highs. Ctrip.com also beat top and bottom line, raised guidance, and the stock performing very well today, up from about $35, up more than 20% today. So very strong day. And then on the flip side, we had Align Technology. There was an arbitration, and Align is being forced to close 12 Invisalign stores. And as a result, was going to get hit with a charge in the first quarter. And investors not liking the news. You can see stock trading down about 6% today. This was the worst performer in the S&P 500 when I last checked. All right, Erin, well, yesterday about this time, we had a lot of selling going on. Yesterday afternoon, we rallied back a little, and you can see from the numbers today, market just doesn't quite know what to do here.
No, it really doesn't. And it's funny, I was talking to my father yesterday, happened to be in Redlands as I prepare for my move to get to Redlands. And, we were both just sort of shaking our heads. He says, this is just one of those, another time, where the market is. I told him that basically I said, it's really hard to be a bear. And he said, yes, he agreed. The market is not cooperating, but it is time to sort of roll over. We don't, we've seen it just go sideways to clear some of those overbought conditions. And that's the thing I'm trying to determine. Are we going to go sideways from here to clear those overbought conditions? Or are we going to take a big pullback or correction to do it?
Yeah, and we get a lot of mail here at Market Watchers Live, and a lot of folks, a lot of you out there have said, okay, well, now we're getting up to the key area. This is the key area. And, you can look at the chart and argue a lot of different key areas, but I agree, this is a big one right now. Mm-hmm. And the bears dug their heels in yesterday. Literally, the S&P 500 got within 6/100ths of a point of the highest reaction high off of, the 52, or the all-time high when it first started selling off in October. Mm-hmm. That first reaction high on the S&P went to 2816.94. And yesterday we got to 2816.88.
Right.
That's pretty darn close to hitting resistance.
Exactly.
And then we saw a lot of selling. We saw the volatility pick up, and I thought, okay, this is the bear's chance. And I'm not going to say it's failed yet, but they haven't been able to really, jump on board and really take this thing lower. I mean, even with all the selling yesterday, the 20-day EMAs were not touched, and they haven't been touched on this move in 2019, this huge rally that we've had. So there's still a lot of work to be done on the bear side. You got to be somewhat encouraged on the bullish side that you were able to stem that selling yesterday with the volatility picking up. But I think that we're still in battleground here. I think this is a big battleground.
Yeah, absolutely. It sort of reminds me a little bit when we hit 2,600, although the bulls didn't have that much trouble getting through that after a day or two.
Yeah, well, this one is a bigger one, I think.
Yep.
We had multiple reaction highs back in October, November, and December, getting back to just around this 2,800, 2,815 area on the S&P, and that's where we're struggling right now. So it's possible we turn back down. I'm going to give the odds to the bulls eventually to break out, but I'm not saying that it can't, that we can't break back down. I think you have to be recognizing some of those key support levels.
Absolutely.
All right. Well, we've got a full lineup. I know I got to do my workshop in a little bit, so we probably ought to get this thing started.
Exactly. Want to give you lots of time. All right. Upcoming schedule. So tomorrow, Milan Vashnu will be here to join us. And on Thursday, we will have Bruce Frazier, Mr. Wyckoff, joining us. And on Tuesday of next week, I will be doing a workshop. I'm not really sure what I want to do it on. So if y'all put something in the survey comments, just you can go there below the viewer and give me some ideas. That would be excellent. And then we have Linda Rashke coming on Wednesday of next week. I adore her. I can't wait for you to hear her. Definitely plan on tuning in next Wednesday. But now, today, what are we doing? As Tom mentioned, he's going to be doing a workshop on industry focus. So that'll be very interesting to see which industries he's looking at. 10 and 10, our very first symbol will be United Health Group, UNH, if you want to go take a look at that before we get there. And then we will finish the program off. I'm going to do technical scans and basically walk you through I think there's like 5 favorite scans I have, and I'm going to walk you through those, and I promise to print those in today's Market Watchers live recap. So let's get going. Technical news and headlines.
Okay, let's jump into the economic reports first. We did have February PMI services come out. Just about matched expectations, fell a little short, 56.0 versus 56.2. Then the lagging new home sales report from December came out and did beat 621,000 versus 590. I did think it was worth mentioning, though, that the November new home sales were revised quite a bit lower, 599,000 versus 657,000. And then finally, we had the February ISM non-manufacturing index come in stronger than expected, 59.7 versus 57.2. So as we pull up the 10-year Treasury yield and see the bond market's reaction, well, we moved up a little bit. We did push higher by about 2 basis points. I'm going to make sure I've got the latest here to update. Yep, still up 1.8 basis points, almost 2 basis points. And that's good news, I think, for the equity markets, because we have now broken above this 20-day moving average on the Treasury yield, so far holding it. I don't think we're out of the woods yet. First of all, we did bounce off of the 255 area, went all the way back up to 280, and we've really been kind of sideways consolidating, getting back up above the 20 and the 50-day moving average around that 270 area, but still unable to clear what has been fairly difficult resistance over the last 10 weeks or so at 2.80%. So in the middle of that, but that's better than being down at 2.63 and threatening this breakdown. So things have improved, but we still have work to do on the 10-year Treasury yield. And remember, as the yield goes up, it means Treasury prices are going down. That's generating proceeds from the sale or sales of those Treasuries, and that is money that becomes available to rotate into equities. So if you look at the short-term history, short-term charts and the short-term relationship between the 10-year Treasury yield, the TNX, and the S&P 500, they tend to move in the same direction. And some of the biggest moves in the S&P 500, and this has not really been the case this time, but some of the biggest moves when you go back and look at the history of the S&P 500, many of those big moves have coincided with moves up in the 10-year Treasury yield as well, because you see that rotation taking place, money rotating away from Treasuries. All right, let's take a look at the earnings reports, and some pretty good ones came out last night and this morning. Target Corp came out this morning. They did beat. You can see Kohl's beat, Sienna beat. After the bell tonight, we have Ross Stores, COO, Urban, Aero Environment, and Ambarella. All of those stocks, some of those last couple ones were like maybe $1 to $2 billion companies. The others were slightly larger. But still, there are companies, even during this kind of slow earnings period, that we still do have companies, significant companies, reporting, and we'll have a few more of those out tonight. All right, let's take a look at what's going on in some of these charts. We're going to start with Target. Target, I think, looks very compelling, but we've got some overhead resistance, and I'm going to go ahead and annotate this first. I see some real positives on the Target chart, but the biggest negative is we have yet to negotiate this heavy volume gap down that we saw back in November. With today's news, very heavy volume on the upside, and we're right to this level. A breakout, I think, would be significant, because when you look down here, first of all, you've got the broadline retailers trying to move up above their January high. They've been kind of stagnant here in February. On a relative basis, Target has broken out above the broadline retailers, versus that group as a whole. So you've got a relative breakout versus its peers, although it's still way down from where it was back, 4 months ago. But we are getting at least a breakout to a 3-month high, which is good news. Then when you look at the S&P 500, also breaking out to a multi-month high, good news. And the group relative to the S&P has been a laggard for about 6 or 7 months, but over the past week or so has started gaining ground. So still a lot of work to do on this particular chart, but I'm seeing some positives build here on Target. So if we can get through, let's call it 76 and a half, 77 for sure. With this kind of volume, if we can close there today, I think that bodes well for Target down the road. We may still see a pullback because we are having a nice day. The stock's up more than 5%. But I think longer term, we start going out weeks, maybe a couple months, I would expect that we're going to see higher prices with Target. Next up is Kohl's. So let's get out of here. And I'll keep this also on the relative chart so we can see Kohl's. KSS. Now, this is in the apparel retailers group, but like Target, you can see breaking out above some key resistance levels, trying to get through key gap resistance. Notice the gap down that we saw on Kohl's back in November, which was at about 70, a little over 70, and we kept struggling every time we get up there. Well, today, if we hold, we've got great volume. I want to see this close at the current price or higher. I think that would set up very well for Kohl's. Now, from the apparel retailers standpoint, they've performed a little bit better than the broadline retailers. Not a whole lot, but a little bit. And Kohl's, with this news, has started to break out against the apparel retailers and looks like it is breaking this relative downtrend line versus the S&P 500. So some good things. But overall, apparel retailers, broadline retailers still showing some strength of late. I'm going to say the last week, but got a lot of work to do to take out relative highs. So both of those are improving charts. Great news. But still, we've got some issues. And then finally, Sienna. Sienna came out with some very, very good news. In fact, they actually beat top line and bottom line. They beat their top line, and I'm talking about revenues, by a roughly 2.5%. They were looking for $761.6 million. They came in with $778.5 million. Easily beat bottom line, 33 cents versus 30 cents. Stock gapped up, pulled back, but is holding price support. I think the pullback today after earnings were reported is an opportunity to get in. I like the group, which is the telecommunications equipment group, and I think Sienna has been one of the better performers. So here is the telecommunications group, which has been on fire over the past 2.5 months. Sienna, double top in play, but I think as long as it holds this relative support here, starts to turn back up, I would suspect that we'll see another relative breakout. And because it is performing strongly in a strong group, there is no doubt about its outperformance versus the S&P 500. And telecoms recently broke out. Telecom equipment recently broke out versus the S&P 500. So we got a good one there. The last one I wanted to mention, C-Trip reported after the bell last night. Very, very strong report. Easy beat on the top line. Bottom line, 13 cents versus 4-cent loss expected. So beat by 17 cents. And then they guided their Q1 revenues higher. We definitely have a change in character here on this chart. I think looking back, you can see we are clearly in a downtrend. We started uptrending, and now we're getting the confirmation from earnings with huge volume. So this is a stock that I think the top of gap support, which is 39.79, is going to become a very key area of support. It has broken out clearly versus the travel and tourism group, and this group has not been very strong. Of course, we just had Booking Holdings come out with a disappointing report not too long ago, and that really hurt this group. But I would say C-Trip is one of the better ones within an overall weak group. All right, Erin, upgrades, downgrades, what you got?
All right. Interestingly, my first upgrade is C-Trip, so you get to see it on my chart and see what I'm thinking about it. All right, so let's go ahead and get started here. I'm going to make this nice and big. All right. So for me, I found, the different support and resistance levels based on obviously the top here, which lines up with the low here, tops right here that line up with the low here. So we managed to just, with that gap up, pretty much obliterate the $40 level, which I was looking at as an area of overhead resistance. I'd say the next area, and I'd say loosely, I think it'll have no problem with the $44 level, mainly because it is lining up here with this support here, our previous resistance back here. You can see both in there in July and back in April and May. But it's not what I would call a major area of resistance. I would be looking up here, of course, at that top we had back in June as the major area of resistance. I don't see any reason why it couldn't move higher, except for the fact we are going to start getting really overbought here. So it'd be nice to see a pullback to the $40 level. I think it could be interesting then, but obviously you'd be chasing it with an over 20% move today. Pretty impressive. C-Trip actually was upgraded by, 4 different agencies today. And so I thought that was very interesting, and a lot of interest in C-Trip right now. And Canna was upgraded today by Macquarie from a sector perform to a sector outperform. As you can see, we got the PMO buy signal back here in mid-February, and we finally managed to get over this area of overhead resistance, and it is holding as support, but we're really not getting much action past that. Maybe with this upgrade it'll help, but really we're only looking at just a little over 0.5% move to the upside, 0.2% around in there. I would have been expecting a little bit more. I would have expected, if you look in the thumbnail, I would have expected on an upgrade to get a breakout there. We're not getting that, but it's still holding that support level. So I think this one would be worth a watch. You can also see the 20 and 50-day EMAs getting ready to have a positive crossover, and that is an intermediate term trend model buy signal. So as an intermediate term investment, this might be a good one to look at. And then here's the gap. This is where I'm looking at the next area of resistance. I think you could make a case for it down here at these lows, but I think the area we really want to pay attention to is the gap resistance here, and that's the gap that still needs to be closed. So we want to watch it, and the idea is, if we're on a nice rally, if this is going to continue, that's what we want to see, is a gap closure there. And actually I could bring that higher because I could see my eyes. I didn't have my glasses on. All right, here we go. Right, see, the gap actually is back here on that particular OHLC bar. So there you are. So $10, $9 and $10 is kind of where we're looking right now for the next area of overhead resistance. Watch it though. If you wanted to get in, you could have a very tight stop, I'd say, because this is the area of support that really needs to be held right now. All right, the next one, Immunogen, was upgraded today by Morgan Stanley from an underweight to an equal weight. It had a really bad week last week with that huge gap down. Of course, that triggered a sell signal on the PMO, and you can see the OBV just went down to the basement based on that high volume bar. Not looking too good, but it did get an upgrade. And I have to say it's a little bit interesting at this point, because we could see that gap closing, but this has just not been the best performer. Biotechs, I think in general, haven't been performing like you'd want to see them. This one in particular, I would say you can see just really a trading range here, and then drop, and now another trading range. You could even, I think, make a case for this V bottom, and maybe put it in as a reverse head and shoulders, kind of a loose one. Got that breakout above what would have been the neckline, and then we failed. So I don't like it. If you like to bottom feed, I suppose you could keep an eye on this one, since it was just upgraded. All right, let's look at a few downgrades. Bluebird Bio was downgraded today from an outperform to a market perform. And you can see it hit this overhead resistance here at 160 and just really pretty much died. I looked at this as a reverse head and shoulders. And when you get that breakout, of course, you should expect to move the height of the pattern. And we weren't able to fulfill that. And in fact, like I said, we hit that 160 level and just turned back down. The PMO is really overbought right now, and it is turning over. if you wanted to watch it and see if it got down to the 140 level and maybe try and catch a bounce from that support level, I think that would be not the best idea, but it's certainly something you could do. Endo Pharmaceuticals today was downgraded as well by SVB Leerink from an outperform to a market perform. And, as you can see on the downgrade, I certainly would agree with it. I would have been watching that $9 level, and yesterday you could see came down and almost got down to the $9 level. That was a pretty bad breakdown, and that would have been my warning right away that probably a good idea to get out of this one. And then we did see follow through on this decline. It's still falling, and you can see it was all the way up here at 1125 on Friday, and now it's all the way down to 875. So pretty bad hit. Maybe it'll hold on to the $7 level as support. Keep an eye on the PMO. Maybe there'll be an opportunity, but look at what happened to the last PMO buy signal. Not a whole lot. So, just keep an eye on that if you did choose to come in at that $7 level. All right, one more to go, and then I'm going to pass it back to you. Fortuna Silver Mines was downgraded today by CIBC from a sector perform to a neutral. And as you can see, I certainly would want to be in it. I'd be watching support at $3.25, maybe $3. PMO on a sell signal. IT trend model getting ready to give us a sell signal with the 20 crossing below the 50, below the 200. So it doesn't look too good here for the silver miner here. That's all I had. And here is the wrap up. We had just one other upgrade that I thought was interesting, Sientra. And then as far as the downgrades that I didn't cover, you have Nightstar was downgraded by 4, and actually Atomos Pharmacy was downgraded by 3, but I forgot to, I did put that in there. Excellent. And Unity Group. All right, Tom, I went a little bit over, so you can go a little bit over to the 10 and 10.
No problem. All right, I'm going to go ahead and get started, and I'm going to do this workshop on industry focus. First, I want to thank everybody for their suggestions. I did go through and read everyone's comments and suggestions. Most of the suggestions focused on me looking at either my strong earnings chart list, gaps, how to trade gaps, or industries. And so I'm going to try to bring a little bit of all of that into one workshop, but I'm going to do it from a top-down approach. So I'm going to start with the industry. So that's why I call it industry focus. So let's go ahead and take a look first at the relative strength of a couple of sectors, because you have to understand where I'm coming from. Most of the industry groups that I'm going to look at today are going to be within those aggressive sectors. I've turned much more bullish in the overall market. I think prices go higher later this year. And so my focus is going to be on trying to find groups in that type of an environment. Of course, that's subject to change. If the market breaks down, I'll have to reconsider. But based on what I'm seeing so far, I'm going to stick to a pretty aggressive approach in 2019. And I want to stay mostly with the aggressive areas of the market. So first, let's take a look at the XLY. This is consumer discretionary relative to the S&P 500. So if you're looking at trying to outperform the S&P in an advancing market, you, for the most part, need to be in the aggressive areas to do so. Defensive stocks will typically go higher in a bull market. Bull markets are typically show wide participation. In other words, a lot of things go up in a bull market, but your aggressive areas will typically go up faster. So I'm looking at the XLY, and what I'm seeing is an uptrend into the first half of 2018, little sideways consolidation, an actual breakout on a relative basis in January, which I thought was pretty impressive, given that the market had just gone through so much negativity in the fourth quarter that on a relative basis, consumer discretionary could break out in 2019. So that is definitely going to be an area of focus for me, is the consumer discretionary. Yes, we've kind of pulled back a little bit, but it's within the confines of a much longer or uptrend. And I could, we could go back a ways. If you go all the way back 10 years to when the bull market started in March of 2009, you can see that this move to the upside has been continual. You go through periods where on a relative basis, consumer discretionary will weaken, but then you break out and you start moving to more highs. Well, this is telling you when you start trending higher, it's telling you that more money is rotating into consumer discretionary. So your odds are going to be greater trading stocks in that sector. All right, now we could go through and I'm going to shorten this back down. I don't need 10 years. Actually, we'll stick with 10 years. I think everyone will be able to see basically what's going on here. So let's go to technology versus the S&P 500. I don't think there's any doubt in my mind that we're in an uptrend. I mean, yes, we pulled back in the fourth quarter. Fourth quarter did a lot of negative things, and that is typical of a cyclical bear market. But we have come right back out. And as the market strengthens in 2019, money is rotating back into technology, which I find to be very bullish. If the market was turning much more defensive as we rallied, you wouldn't see these relative lines going up in 2019 on some of these aggressive areas of the market. If we pull up communication services, compare that to the S&P 500. Once again, uptrend. Yeah, we topped back in July of 2018. We pulled back, but I think we're starting to regain strength. And we're going to want to watch to see if we get a breakout above this 0.0170 and 0.0175 area. That would be a very bullish development for communication services. The last two, industrials. Again, I'm just going to focus on the aggressive areas. Industrials, now you might look at this and say, well, you know, we did go through an extended period of downtrend. Well, I think that downtrend line's been broken. I really think industrials have come back very strong here in 2019, been one of the strongest areas in 2019, actually. And so I like what's going on here, and I think that has ended this sideways to down period of consolidation. And then finally, financials. Now, this has been the weakest area among the aggressive sectors, and we haven't seen that breakout yet, but we also, I don't think, have seen a breakdown. So if I annotate this, just like a price chart, if I've got prior highs, broken resistance, or in this case, broken relative resistance, becomes relative support. So I think we've held where we needed to hold, and I'm assuming the 10-year Treasury yield is going to move higher. One of the things that's really held financials back on this rally is that we're not seeing a rally in the Treasury yields. That yield spread is not really, widened much, and so this has not been a great environment for financial stocks, but I think it's going to be. Whether it is or not, we'll have to wait for confirmation. But if we start to see that 10-year Treasury yield moving up, breaking above that 2.80% area I spoke about earlier, then I think you're going to start to see relative strength coming back into the financials. Until then, I think we'll just go sideways. I think financials will go along for the ride. I don't think you'll necessarily see much leadership here. Okay, so those were the sectors compared to the S&P 500. So now let's take a look at some of the industry groups that I think are some to maybe consider and to focus on. So I've already gone through and set these up. Now, this is one that is outside of the aggressive sectors. Medical equipment is in the healthcare space. Healthcare is a combination of aggressive and defensive, in my opinion. Biotechs are certainly aggressive, more aggressive. Pharmas are more defensive. And then you have the others which kind of fall in between. And so medical equipment, to me, you can have a lot of really good growers in medical equipment. And I think this kind of proves it out. I think if you look back over the last couple of years, you'll see that medical equipment stocks, many of them have really grown their bottom line. And as a result, this is a group that continues to lead the S&P 500. So it's a group that I want to continue to consider. Aerospace. I love it when a group is a relative leader and then consolidates for a period of time and then breaks out again. So I am looking for more leadership from aerospace throughout 2019. Telecommunications equipment moved up, broke. It definitely was in an uptrend. Went through a period of consolidation, even a relative downtrend for 2 or 3 months. Broke out, strengthened again. We just saw up until maybe the early part of February a little bit of consolidation on a relative basis. And then here comes the group back again, setting a new high. Pulling back, but I might watch that rising 20-day moving average. We might see a turn there, especially since we have a little bit of relative support that'll come in at that level as well. Financial administration stocks continue to perform very well despite financial stocks not doing so great. Financial administration has continued to lead. So this has been one of the better areas of the financial sector. I think that their relative strength kind of speaks for itself looking at this chart. Footwear. This is in the discretionary area. Sideways consolidated for the second half of 2018, broke out, and we're seeing relative strength again. Hotels. Hotels, was watching this area, and you have to understand, I'm going to go back and pull up a little bit longer chart here. We'll do the full 10 years. When the overall group, when the consumer discretionary does pretty well, normally you're going to see hotels do pretty well also. Now, we did just break out on the consumer discretionary back in January of 2019. I showed you how the XLY moved up to a new high. And now, right on the heels of that, we're starting to see some relative strength pick up again on the hotels. And when you look back, this is a group that can outperform for an extended period of time. We saw it, look at 2016 through 2018. Again, this isn't just hotels going up. This is hotels going up a lot faster than the S&P 500. That's why you're getting this relative strength. So we went through a period where we were kind of giving back some of that. But the overall, when you look at the main, these big pullbacks, all of them are higher than the prior one. And I think that was a fairly significant reaction, relative low back in Q4. Notice that was in like October. And by the time we got to the December low in the market, hotels were acting much better on a relative basis. And I think that's continuing now. So this is a group that I want to pay attention to as well. Internet stocks. When internet stocks go, you want to be part of it. I think you can go back in 2018 and look at March to July and look at the relative strength. That's a big move from 0.57 to 0.68. That's a big move relative to the S&P 500. When these stocks get, start moving to the upside, you want to be part of them. And of course, when they're down, they can go down pretty fast as well. But that downtrend seems to have ended. This is acting much, much better now. I think internet is an area we want to look for. Now, part of my philosophy too is when you're looking at these industry groups and you see, strength building or maybe a reversal, keep in mind, I'm going to only be looking at stocks that are on my strong earnings chart list. I'm going to be looking for the best of the best. So if I like internet stocks, I'm going to then go to my strong earnings chart list, pull up my internet stocks in there, and I'm going to try to find some of the ones that I think look the best technically. And those are the stocks, especially if I can find a really solid reward to risk entry, those are stocks that I'm going to be most interested in. Specialty retail. Talked about this group many times. Huge move up in relative strength in the first half of 2018. Went through this period of, this is almost, well, I think it is a bullish wedge. I think you can use these wedges on relative charts just like you do on absolute charts. So here is your relative strength moving up. And then when I use these patterns, I like to use the black lines. But if you come in here and you connect these highs right there, and then you connect these lows coming across here, you got a bullish wedge. So you've got, a bullish relative wedge or relative bullish wedge. I don't know however it goes. But here's your uptrend. Here is your consolidation, and here is your breakout. So I believe this is a group that's going to continue to lead, and confirmation would come on a breakout above that June 2018 high. We tested it in January, didn't quite break out, but this is a group that I would certainly expect if the consumer discretionary leads, and this time of the year is actually pretty good for retail, spring. This is a group I would be looking for a relative breakout. And if it does break out, I think you're going to want to have representation in your portfolio. All right, a few more. Restaurants. Now, this is an interesting one because when you look at it, the last 2 months, it's been downtrending. I'm going to maybe show you something interesting on the RRG when I get to this. But I think this relative area of support, I would watch this pretty closely. And a breakout back up above that 20-day could be the signal of the start of another big run to the upside in restaurants. Restaurants, you can see, did incredibly well on a relative basis in the fourth quarter. While most other areas were selling off, restaurants actually held their own and then ended up breaking out. So pretty good action on the restaurants. I think they're consolidating, but I look for further strength ahead. Semiconductors, this is much like the internet group. When they're strong, you want to make sure you have representation. This group was very weak for about 6 months, mostly in the second half of 2018. But 2019, we are now trending higher. I think as long as we're trending higher in this group, you want to be looking at semiconductor stocks. Specialty finance, huge move up for about a year and a half. And then we went through about 6 months of consolidation, the second half of 2018. And now look at the strength building again on a relative basis. It's going to be a lot easier to outperform the S&P 500 if you're trading stocks within groups that are either outperforming the S&P or starting to turn back up and beginning to outperform. Software index. I don't really need to say a whole lot here. I think it's pretty clear. Software has been a great area of the market for quite a while, and it continues to be. Even though the last few days we've seen some relative weakness in the group, overall the trend is higher. I mean, you're not going to go up on a relative basis every day. Let software pull back a bit, but I think we're going to see continuing strength in this group as we go forward. Okay, so I think, that was it. So those were the 12 industry groups that I'm looking at most closely. There's some others, and there were some in the poll for today that I didn't go over just now that have been very strong over the last 30 days. And some of those groups certainly bear watching and potentially could yield some nice trading candidates. But these are the 12 that I looked as I was going through, the ones that really grabbed my attention. And most of these are in those aggressive sectors. So now let's move on to the RRG, because this is one way of looking at it with the relative strength on the price relative charts. But look at the relative rotation graphs. I'm going to start with the 5 aggressive sectors. Now, when you look at this is as of today over the last 5 weeks, and you can take a look at what these stocks have been doing, or what these sectors have been doing relative to the S&P 500 over the last 5 weeks. Technology, long tail here, moving back up from lagging through improving and moving in that northeast fashion that you want to see heading into the leading. 3 of the groups are already into the leading. And look at industrials. I mentioned industrials have been so strong. This is how it appears on an RRG chart. Of all these, I think it has the longest tail. And if you've ever heard Julius de Kempenaar when he comes in here, Julius was the creator of RRG charts. But when he talks about these, he talks about the length of the tail being very important because it's telling you the thrust of this move, this relative strength. And I think clearly XLI and the XLK are the 2 that are really strengthening as we head into, well, certainly over the last 5 weeks, as they move into or toward the leading quadrant. Communication services already in the leading quadrant. Consumer discretionary, as I mentioned, already there. Financials, even with the 10-year treasury yield being so weak, and I would say this is the weakest of the 5 groups. Tail's a lot shorter, but it is still moving in that northeast fashion. So you've got all 5 of the aggressive groups, I think, suggesting that this rally that we've got going on is sustainable to the upside. Now, I just went over 12 industry groups. So I'm going to bring up the relative rotation graph and show you these 12 industry groups. Now, when you look at this, the first thing that really just stands out to me is the restaurant group. Long tail and weakening. It looks like it's really weakening rapidly. This is a group that maybe we shouldn't be considering. Well, I want to show you how a group gets like this. So let's take a look at I'm going to go into the industry summary. Table view. And let's take a look at consumer discretionary. Now, this is intraday. Let's go back 1 month. Now, 1 month, if you look for the restaurant group right here, it's in the middle of the pack, up 1.85%, nowhere near the high. If we switch to 3 months, you will see that the restaurant and bar, where are they? Here we are, up 1.6%. Last 3 months, not really doing anything, and more toward the bottom of the pack than the top of the pack within consumer discretionary. But I want you to take a look at 6 months. Look at what's leading by a wide margin: restaurants and bars. So over the last 6 months, this has been the best group. And in fact, outside of footwear, it's 10 percentage points higher than any other area in consumer discretionary. So you have to understand how strong this group was before the lagging 1 and 3 month period goes. So when you look at this, you say, okay, this was a really strong group and has been for the last 6 months, but the last 1 to 3 months hasn't been so strong. Well, this is how that appears on an RRG. Because way over here to the right, this is the relative strength ratio on this axis coming across here. So the horizontal. Well, restaurants, if we scroll back here to at its peak, look at where it was. Way over here to the right. Way to the right of all these other groups that I'm looking at. And why is that? Well, it's because at that period, this, restaurants and bars, it had outperformed everything else in the market, basically. So that's why it was way over here. Well, a group can't continually outperform for long periods of time, or at least it's not likely. You're going to go through periods where money rotates out of that group. Traders take profits. Investors, portfolio managers, they take profits on groups that move like that. So now what we've got is a restaurant group that is sliding into weakening. But as Julia says, a lot of times what you will see is a very strong group, after it goes through a period of weakening, will turn back up and head into leading. And so that's why I like restaurants. And that's why I own CMG, Chipotle, because I think that is the best stock, or certainly one of the best stocks in a group that's been very hot. And I'm looking for some more leadership from this group later. And if I'm in one of the stocks that's the strongest, hopefully it will do very well. But take a look at all of these groups. Do you see the direction that they're heading? These are all the ones I just showed you on the price relative chart. And remember, hotels were kind of like the weakest. They had been downtrending and they were just starting to show strength. See how they're coming out of this? They're still in the improving group, but they're moving toward leading. Everything else is either in leading or is rotating out of leading into weakening. And then you can see telecom equipment actually turning back up like it wants to head back into leading again. So this is kind of how you want to see your groups on an RRG chart, in my opinion. Now there are some, and I'm going to add one here. I'm going to go all the way out here, and I'm going to add pipelines. And the reason I'm going to add pipeline is that this is a group that has been very strong of late. And I'm going to go down here and find it. Okay, there it is. So you look at this, you say, well, why wouldn't you want to include pipelines? Pipelines have been incredibly strong. Well, there's a couple reasons. Number one, it's part of energy, which is that's not one of the aggressive groups. Number two, there are a lot of things that can influence energy and the groups within energy. And one of those is the dollar. And so if the dollar is strong, then I'm going to have some questions about pipelines. Now, if I go back to this price relative and I put pipelines in here and I go back, do you see the difference in this chart versus the others? I mean, yeah, we're seeing some strength here for a couple of months. We've seen that before. But the overall trend here has been lower. Now, if we could maybe get up and clear this relative price resistance here and break out, and maybe if the dollar starts to show signs of weakening, then pipelines would all of a sudden be a group that I'd be more attracted to. But I've seen this, these tricks before, where you get some nice short-term relative strength, and then you roll back over again. We've been seeing it with gold. I can come out of here, and we can basically look at the same thing with the price of gold. Just pull up GLD. And, we saw some relative strength here for a couple of months, but now look what's happening. Why? The dollar strengthening. And so when the dollar's weak or when there was a lot of fear in the market back in the fourth quarter, gold can do well. But the overall trend, and if I go back, 7, 8 years, that's why I said, over the past few months that I was bullish on gold in the near term. But if it started to roll over, you want to be careful. And it's, in my opinion, it's rolled over and is no longer. It's clearly underperforming the S&P. The dollar's still in an uptrend, and so this is a group that I wouldn't want to be interested in. So when you see the strength build for a period of time, I think it's a good idea to step back and look at a big picture before you start to decide to jump in to some of these areas or to make long-term predictions based on a short-term performance period of time. All right, I am going to go into my strong earnings chart list now, and I'll pull up a couple things. First, let's view all, and I'm going to put this in summary form, and I'm going to type in restaurants because I said I really like the restaurant group, and you can see what comes up. Here are the stocks, and I can sort these in scooter order, and look at the one that's on the top, Chipotle. I pull up Chipotle, and I've got a couple of key areas of support that I'm going to watch to the downside. The first one, the major one, in my opinion, is gap support. I know there were a lot of you, or a few of you anyway, that were asking about maybe looking at gaps as part of the workshop. Well, one of my favorite gaps is a stock that's either going sideways or is already going higher, and it gaps up. You get a continuation kind of a gap. So here we had an uptrend, sideways consolidation, continuation gap. And we're breaking away from the prior highs. Now, on this gap, notice we didn't go back and fill. In fact, the low of the day was almost at the opening price. And look at that volume, really about the strongest on the chart going back, last several months. So when I get a stock that gaps up and continues moving higher the next few days on heavy volume, I look at the top of gap support as the major support level. I don't look to go back down to test this prior high, which becomes support, or to go back and fill this gap. Maybe we will months down the road, but I'm a short-term trader. I don't care about months down the road. I care about what's going to happen over the next few weeks. So if CMG somehow were to pull back and hit 565, 570, I think that would be the best entry on this chart. Now, I don't know that we go back down there. I think eventually we will, but I don't know it's going to happen anytime soon. So I'm in Chipotle, and I'm simply watching the 20-day moving average. As long as we continue to trade above it, which we have since early January, I'm going to stick with the stock. So now you've got the 20 coming up. It's at 590, and you've got those recent lows. I could annotate, draw one more line in here. You can see these recent lows after we had all this movement to the upside and all this buying. Sellers could only take us back down to about 595, 593, something like that. And you've got the 20-day coming in right underneath it at 590. That, to me, is a very key short-term support area. All right, let's see. Going back to that strong earnings chart list, how about we go in and we type in internet? Talked about internet building strength. All of a sudden, when I bring up internet stocks, I can see the ones that have the highest scooter scores. Now, I actually got into GDDY, so I'll pull this one up and show you what I liked here. Yesterday, it went right down and hit gap support and the 20-day moving average. Bounced off of it. Today, it's showing a little strength. We might go back down again, but getting in close to gap support and at the 20-day, I can manage my risk. If I get back up to 77, if it happens quickly, especially if it were to happen on light volume, I'd probably just take a small profit, move on, move back into cash. But that was, again, using my strong earnings, knowing internet stocks have been stronger, and just, keeping this strong earnings chart list and being able to quickly look at these for some strength. Snap, the highest scooter rank. Look at the stock gap up. It broke its downtrend, continues to trade up above that 20-day moving average. So Snap is a good one. And let's take a look at maybe one more industry group in this list, and that would be Kind of looking back over my list to try to decide. How about, I don't even know if I have specialty finance stocks on here. I don't own one. No, there's two of them. Okay. So specialty finance was an area that has really caught fire of late. So there's two of those on the list. One is MSCI. And you can see that this one clearly just broke out above this high, continues to trade over the 20-day. I mean, you can see these stocks are outperforming on a relative basis. Yes, yesterday was a bad day. We saw some of these stocks underperform. But when the market's going up, these are stocks that tend to outperform. And so these are the ones I want to focus on. The other one was HTGC. This one coming back down and getting closer and closer to a key area of support. So a test of the 20 would be interesting. Gap support at $13 would be interesting. And then you've got the bottom of gap support at about $12.90 or so. So as this stock, which was almost to $14 a little over a week ago, as it gets closer to $13, all of a sudden your reward to risk gets a lot better, and you're getting into a group that is showing relative strength. So these are some of the things that I would be looking for. Okay, let's go ahead and pull up that summary slide. And you can see I went through, showed you how you can analyze industry strength. I used the price relative charts. Then I went through and showed you on the RRG how you can analyze them. And then we took that information, went into a strong earnings chart list, and tried to pull up some individual stocks that could benefit from the relative strength in some of these groups. All right, let's move on to the poll and see of these 6 industry groups that were listed. These are 6 of the strongest industry groups over the past month. Which one of these do you feel best going forward? And the overwhelming winner here, Erin, is telecommunications. Which one do you go with?
I went with telecommunications. And honestly, I did that. I did not look at any charts, so I'm going to admit it right now. It's just a matter of what I've seen in that particular sector and that space, and I like it. So,
all right. So you went out. You basically went to the horse races and picked your horses by number. You didn't
exactly. Yeah, by the name.
Yep. Yeah, you didn't look at the racing form.
I did not, and that's why I admit to that. So we'll see if I'm right or not. I don't know.
All right. This was, I was looking at it and I was wondering myself, but I tell you what, I really like the consumer discretionary area. And I think hotels, because they have been beaten down and they're just starting to show strength. I agree. I really like telecommunications equipment. So this is a tough one. I like the top 2 that everybody picked here. And I like the third one too. I like real estate services, but I'm going to go with hotels.
All right. Yeah, my second choice was hotels, actually.
There you go.
Yeah.
By the number or by the name?
No, again, just by familiarity with what's going on in that sector. So.
All right. Well, hope everybody enjoyed the workshop and the poll. And I guess we will now move on to the 10 and 10.
Indeed. And I do have a lovely RRG coming right up for you guys here.
Yeah, Julius would be so proud of us using all this RRG in our show now, right?
Oh, I know. And you use it a lot now in your blogs as well. So, yep. All right. Well, there you go. Lots of moving northeast direction that everybody chose. There's only a few that aren't moving in that direction. So interesting that you guys picked that. And then as far as sectors go, technology is the big winner today, yet again.
Hey,
and
Erin,
healthcare.
But before we switch over, why don't you highlight Tandem?
Sure.
It's up just a little higher, back down now.
There it is.
And let's run through like a period of time on the chart. If you can grab that chart. Yeah, animate.
Oops. Where'd it go? Oh, here it is. Let me make this bigger so we'll be able to see it.
That has been a great performer. And the reason I wanted to bring that up is this is what Julius refers to when it's way over there on the right and it comes back. Remember, I was showing you how the restaurants came back down and looked really weak. And then all of a sudden I'm looking for it to do what Tandem just did.
Mm-hmm.
It's been a great performer, but everyone takes profits. It weakens. Yeah, try it again. You can't even get the thing over there.
I can't. It's so far to the right. Try one more time.
But it's pretty wild. And that's exactly what Julius talks about. And I think it's pretty cool how these stocks will go through these periods and then right back up again,
Yeah.
leading.
I love when he introduced this at, I guess, gosh, it was one of the chart cons in at the Hyatt. I think it was the last one where we had everybody come. And I just remember being absolutely mesmerized when he did this. And I thought, what a simple yet brilliant idea to do this. And so, yeah, I really love it.
Yeah, I mean, I do a lot of it, but I think the RRGs are so much more visual,
Exactly.
especially when you can compare them against a lot of different stocks relative to a benchmark. But all right, we
Yes.
ready?
Yes, let's go. First one, UNH, United Health.
All right, United Health. I don't see a whole lot on this chart. I mean, yes, we were getting close to support. We were oversold, so we're getting a nice bounce today. But when I look at the chart, first of all, the thing that really stood out to me, I talked about healthcare providers for a long time. It was one of my favorite areas of the market. But you have to realize when something breaks. And we had a relative uptrend line in play. It broke, it back tested that line, and then completely fell apart. So there's a lot of repair that needs to happen on this chart. And the selling and the weakness, the relative weakness came on tremendous volume. So, yes, we're bouncing today, but I think we are going to be bound by about 253 to 256 to the upside. And we've got support at 232. I think that's the range that we're probably going to see United Health in for a while.
All right, excellent. The most popular in the chat room is Tandem, TNDM. So let's look at that chart.
Very funny. All right. Yeah, we got the breakout. This is where, obviously, it moved back into that leading quadrant, but it's in the medical equipment area. Now, this is a classic in as far as I'm concerned. If I was a buy and holder, I would be looking for stocks that do exactly what Tandem does. And that is, well, if I can get the chart up, hold on. All right, there we go. All right, so what I look for when you look from the left side of the chart to the right side of the chart, medical equipment group outperforming the S&P. Tandem outperforming the S&P. Tandem outperforming the medical equipment group. Medical equipment group breaking out to new highs. Tandem breaking out to new highs. Look at the volume trends. There's nothing I don't like about this stock. And especially after gapping up, I'd like to see a pullback maybe to test the top of gap support. I think if we could get the stock, looks like yesterday might have gotten close. But if you get down closer to that $60 level, maybe get in a portion there. Second entry, maybe if it goes down to the 20-day, I think that would be a pretty good entry into the stock. You got a great performer here.
Okay. A lot of interest in, I didn't show you guys, but of that big group of technology, all of them were software except for one. So the software one I decided we would look at is why? Yep, a lot of interest in it. Somebody asked, is it too late to buy it around 85?
Whew. Well, I don't like to chase after a day like this. Here it opened. It's different if it opens at 85 and continues moving higher. Then I think 85 becomes a pretty key support level. But here, because it opened down at 72, I think I would wait. I mean, it's just starting to show some relative strength. So it may continue up for, a short period of time. But I think at some point we'll see some weakness. And if it pulled back close to this breakout level, I don't know if it'll go all the way back down to yesterday's open 72. But if we could get back to maybe 76, 77, I don't think that's out of the question. I think I'd be looking for it maybe closer to that level.
All right. The next one I have for you is a software industry company, Workday, WDAY, WDAY.
Yeah, this is one I actually took a shot on yesterday when it came all the way back down here to the price support in the 50-day. So I actually got into this one. It's been a great performer when you look at the relative chart. And this is, stock sold off crazy for 2 days. And when you pull up all these relative charts again, really the breakout was here. But you can see that the strength in this stock has been phenomenal. And of course, you're in the software space. which has been phenomenal for many years, and then throw in price support on top of it. I mean, there was the price support, there was gap support. And we went right down, and the 50-day was in between. So at this point, if the stock gets back up to where it was before, I mean, that was where it was after it gapped up with earnings at 200. So it's come all the way back down to 175. Gets back up to 200, you got a $25 winner, and you got maybe $5 to the downside as support. So I think stock looks pretty good. I like it better if it pulls back one more time, gets closer to that support level. But even at the current price, it's probably got about a 2-to-1 reward to risk ratio. And if it moves down a few more dollars over the next couple of days, I think that will improve.
All right. The next one I have for you is Recro Pharma, and that is REPH. It hasn't been doing much, but I'm looking at it. I wonder if it might close that giant gap.
Yeah, it certainly could. It's in breakout mode for sure. I don't like yesterday's candle off of an uptrend. That's a shooting star. So, but that doesn't mean long-term bad. It just means short-term bad. So I think that I wouldn't be surprised if we get a pullback. This is one that obviously has gaps all over the chart. So be prepared for that, that this stock's going to carry a lot more risk than other normal stocks in the market. These smaller pharmas, they can be very dependent on one drug or a couple of drugs, and you get one bad announcement. And I'm sure that's probably what happened back here in May. One day the stock's at $13. The next day you wake up, it's at $6. So think about that before you decide how much of a position you want in a stock like this. I would keep my position size very small in these small pharmaceutical companies. I know it's always exciting to think about how much money you can make, but you also have to think about how much you can lose if you get bad news to come out. So I think there's a couple things I'd watch for. As Erin pointed out, the gap resistance up here is certainly a possibility to the upside. I think to the downside, the volume breakout these last couple of days occurred at about $9. So I think if you pull back off of this shooting star candle to the $9 level, that would be one entry possibility. The other for me would be the rising 20-day, which has been holding in 2019.
All right. Next one up is Eris Capital Corp, and that is ARCC. My weekly chart looks fantastic, but the daily chart looks like you might have to ride some rough water. It's pretty overbought.
Yeah, the biggest problem with the stock is it's in the asset managers group. It's been a great performer considering how bad. Here's your asset managers. I mean, look at where they were back a year ago versus where they are now. This group as a whole is down, what's that, $55? That's probably 23% from where it was a year ago. And yet, look at what the stock has done within that kind of a backdrop. It's been pretty impressive. So if I was going to own an asset manager, I mean, certainly this would be one that would be on top of my list just because of the relative strength here. I would be watching off of the gap up. You see this heavy volume bar with the gap. I'm assuming that was earnings related. I don't know for sure. But off of that gap, we sold off down to about $16.75 and the buyers came in. So I think that's your key support area. A test of the 20-day, though, to be quite honest, I think I would be a buyer. If you like the stock and you're just looking for entry, I actually like it on the 20-day test.
Excellent. All right. Let's see. We haven't looked at this FANG stock in a while. Google. I think this one looks actually very interesting in the short and the intermediate term. What do you think?
Yeah, I like Google. I think it's one of the better internet stocks. And of course, I was pointing out the internet space strengthening again, and we're seeing a breakout over the recent highs. So yeah, I think Google looks really good here. I think last night I did a webinar over at Earnings Beats, and I pointed out that when the internet stocks, and I'll come back to Google, let me just pull up the internet chart here. When we got this pullback on the internet stocks back on February 21st, see how we hit that price support and the 20-day simultaneously, and we had an uptrending industry group. We bounced right off of that beautifully. If we go back now and take a look at Google, you'll see that on that same day, February 21st, we were back down challenging the prior low, and Google's on my strong earnings chart list. So this is one, unfortunately, I didn't buy it, but this is one I certainly could have made an argument for to buy back when it was testing that support because the group was starting to strengthen. There is your gap support, which had been holding. We've tested it twice, and now we're getting this breakout above this prior high. I think Google's going higher. This is another indication to me, when you get some of the leaders making some noise, I think that helps the overall market. And I suspect next stop on Google is going to be up around 1225.
All right. The next one I have, I think the daily chart looks because my PMO is so overbought. The weekly chart I think looks pretty good, but Verisk Analytics, VRSK.
Yeah, this is one I actually like. Beautiful move up. It's been holding that rising 20-day moving average. It's extended like the overall market, but look at this ascending triangle in its relative chart. So this is versus its peers. So it's been a great performer, and it just looks like it's ready to just burst to the upside. So this is one I definitely like. Now, the overall group, you look back over the last 12 months, it's kind of been going along for the ride. Not a great group, but a superb stock within the group. So I think the stock's made the breakout at 125. That would be one area of support that I would look for. And also the rising 20-day. There's any question in my mind that buyers have been jumping in all the way back here, here, and then again a week ago. So I would just continue to watch that rising 20-day moving average. I think Verisk looks pretty good.
All right, excellent. The only non-software technology request was Applied Materials, AMAT.
AMAT, well, for a long time in 2018, they probably could have been nicknamed Doormat because this has just not been a good stock. But I think there's a character change here. It's slower than a lot of the other areas. You can see on a relative strength basis, it's not really performing that great, although you can see semis are starting to show a little bit of strength. So I think there are better stocks out there than Applied Materials. But if I have to annotate this particular chart, I would be looking at that breakout level and then this, and then the gap support coming in right there. I want to hold that because, again, you've got one of the weaker semi stocks here. So if it rolls over and it fails to hold support, really you should be in a different semi stock would be my suggestion or something to consider. I think there are a lot of other semis that look a whole lot better than Applied Materials. I mean, Xilinx comes to mind for sure, XL and X. Yes, it's risen a lot more and it's overbought, but there's a reason for it. Their prospects, their business is much better. So I think for now, Applied Materials just kind of sitting in this range, 37.5 up to about 41. I want to see the breakout, and we'll probably get it because I think the market goes higher and I think semis go higher. But I think there are other areas of the market, other areas of semis that look better.
All right. And our final one is a specialty retailer in consumer discretionary, Rush Enterprises, and Russia, RUSHA is the symbol. Kind of an interesting flag. I like the flag better on the weekly chart, but interesting.
Yeah, I mean, you can see the volume picking up here over 5 days on this flagpole, and this is the flag that Erin's referring to right here. Volume is a concern for me. I mean, lately volume's been a little better, but when it settles down, you can see many times it's well under 200,000, probably under 100,000. And for me, there's too many stocks out there that are very liquid for me to look at stocks like this one. But I do like some of what's going on here technically. This move up is coinciding with specialty retailers going up. You can see that the stock is outperforming the S&P. The group is outperforming the S&P, but this stock is just kind of a going along for the ride kind of a look to it. In other words, it's going up because its peers are going up. And so if it breaks down, I would be careful. I think as long as it holds on to its gap support back in this area, I would be okay with it. And I do agree with Erin with this bull flagpole followed by this flag. You break out of this with some volume to the upside. And certainly if you can get through this overhead resistance up here at 46, then I think technicals start to look a lot better.
All righty. That completes the 10 and 10. And here are the symbols that Tom just annotated. I will get these up in the Market Watchers live chart list. Just go to the articles tab and click on the Market Watchers live blog, and you will find that link right there at the top. And I also have those links in every Market Watchers live recap. All right, let's go ahead and take a look at what has been going on in the markets while we have been having fun. All right, here we go. As you can see, not a whole lot going on today in the markets. We're, moving mostly sideways, did open lower. We've managed to get to the positive side on the Dow and the S&P. Pretty much everybody is now positive except for the mid caps and the small caps. And I really don't like seeing them underperform. Typically, that's not good for the market. We can see Canadian markets, big gap up, but then really consolidating sideways. Treasury yields up today. We can see 2.735% currently. The VIX, we got that big spike yesterday to 17. Today we only got up to about 15 and a half, and now we are below yesterday's reading, and we're reading at 14.43 on the VIX. UP's actually got a nice intraday flag going on right now. It is up almost 1/3%. GLD down 0.3%, but you can see it looks like it's found its support level at about 121. I would expect to see it just probably consolidate sideways a little bit longer. USO looking a little choppy, but opened up higher on a gap and really stayed in positive territory most of the day. Looks like it might be trying to bounce and challenge up, move up to that intraday high that we see from earlier. TLT forming an ascending triangle here, which is a bullish pattern. So that would be an expected breakout to get us back into positive territory, possibly intraday. So that's what I would be watching. And then finally on our sector summary, consumer discretionary, real estate, and communications are the top 3 leaders. Sort of a mixed bag here of the aggressive versus defensive sectors. And then finally, the laggards are the financial sector and the energy sector, both down over 0.3%. And that's all I have, Tom. I'll pass it back to you and get ready for technical scans.
All right, this is a updated version of a chart that I had in my blog article this morning, and it just highlighted that resistance that we were talking about earlier in today, and we talked about yesterday on Market Watchers Live. But here is that resistance coming across at 2816.94. That was this reaction high back on October 17th. We tested it in November. We got close again in December, and now here we are, and that's where the reversal happened. But if you notice, the bulls, with the strength that we've seen, continue to hold support. Actually, we haven't even tested that rising 20-day moving average. So this is the battleground as far as I'm concerned in the near term. Can the S&P 500 continue to hold its rising 20-day, and can the bulls effectively clear this overhead resistance up at 2816? I don't know if it's going to take news or not, but I do think that I want to watch volume. To see whether or not there is decent volume. You're not going to see volume like you saw panic volume back on December 24th. But we certainly could see an uptick in volume on a breakout above that 2816 level. So that's what I look for to the upside. To the downside, if it loses this 20-day, what you also want to see is this volatility index beginning to pick up to the upside and holding. It keeps failing at the 20-day moving average, but a close above that 20-day with a corresponding close below the 20-day on the S&P is exactly what the bears will be looking for in the days ahead. So let's see how this battle plays out.
Yes.
My guess is we go higher.
Yeah, I'm thinking best case sideways consolidation. That'll work out all those overbought conditions on my oscillators and most of our indicators. You can actually clean up some of that overbought, tightness. You can kind of unwind it just by moving sideways. So I think that's best case, but I still am expecting at a minimum a pullback, if not a correction. So we'll have to see how it all plays out. All right, so let's go ahead. I'm going to talk about technical scans right now. So let's get started on that. So what I figured I would do, I'm not going to really do a lot of how-to here. I'm just going to kind of go over some of my favorites. And one of the things I was thinking about, Tom, is that I actually should get a copy of your strong earnings chart list. I'd be really interested in running some of my scans against it and just see, what would happen with that. So maybe something.
Probably wouldn't like them though, because they gap up and the PMO and the PPO really take off. And a lot of times when I'm buying, the PPO is actually, and the PMO are both would be rolling over.
'Tis true.
Yeah, I mean, it would be interesting, but maybe after a period of consolidation, that might be interesting to see as it turns back up. You could be right. There might
Yeah.
be nice
Well,
picks.
some of these are, I mean, well, we'll get started. I have a couple of scans. I thought I would start with probably the easiest of all of them. And before I even get into that, I will print, because I know everybody's going to ask, I will definitely put the scan language in today's Market Watchers live recap. So look for that this evening. So you can copy and paste those into your own scans. Of course, you do need to be an extra member or above in order to have access to multiple scans. But you know what? If you just need a little help just to get started, predefined scans, I think, are the absolute way to go, because you can just click over here on those scans and they're already pretty much done for you. So for example, that strong volume gainers, there you go. You can just click there and here you get all of those scans. And then if you want, because let's face it, it's got exchanges maybe you're not interested in. Maybe the prices are a little bit, for example, 48 cents. Maybe you're not interested in a penny stock like that. So you can click to edit it. So predefined scans, click to edit, and it'll bring up the actual scan language for that particular scan. And then you can go in and add things like whether you want it to have a higher close, if you want it to be from, for example, a certain exchange or a country. That's pretty much how you can add that and get that going. So that's just a quick and dirty way to do it, I guess, if you want to just go on in and start, kind of dabbling with scans. But I'm going to show you some of my favorites, but I'm going to start with probably the easiest one that I have. And that's just a simple EMA crossover scan. And this one, if I use it, I will either add maybe some more EMA crossovers in here, or I would add, 2050 crossovers. You just change the numbers in here. And so this particular scan is just giving me which ones have a 50, 200-day EMA crossover currently. They have to have a close that's above $10, and I want it to have, decent volume of about 100,000 at a minimum. So I'm going to run it. I don't know if we're actually getting any crossovers currently of the 50 and the 200. Well, there we go. We have 41 right now. And again, I've got some of these indexes in here that I might not want. So I'm just going to go back and add, let's do the exchange. Let's look at only NASDAQ stocks. So I'll put that in. And I believe if we do it, let's see. I think that's the way it will work. Let me double check this. Let's check my syntax. That'll let me know. Yep, that's the right one. So let's look at just the ones on the NASDAQ that are having a 50, 200-day EMA crossover. Let's see if we can get less than 41. 5. Here we go. So this is, again, another way you can just change up your scans just a little bit to kind of, a lot of times what you end up with is, with results, there's just so many. And, that's the time when you want to maybe narrow your scan down a little bit, take out a few, or make it a little more detailed, to add in, like I did here, the exchange, maybe add in higher volume, those types of things. And that will get your scan results to be smaller. But sometimes, and let's see with the next scan I'm going to do, let's look at the EMA. Let's see, the next one I was going to do is, my 5-day EMA crossover scan. Let's bring this so we can see it all. And in this one, I did actually put notes, so it'll be easier when you look at the scan language later from the recap, how, what it's actually saying and what it's actually doing. So I have this particular scan set up. I'm looking for a PMO that's basically been rising for 3 days, and I want it to be in a bull market configuration. So I want the 50 above the 200. And there you go. There's your language there. And then I want those 5 and 20-day EMA crossovers. So that means it's really short-term bullish. These are really short-term crossovers, but it'll give me an idea of which ones maybe are picking up momentum or changing character. So let's take a look at what the results come out to be on this one. 0. So what do? You get this scan and there's no results, and maybe you still want to see something from this. So what I generally do is you start commenting out some of your requirements for your scan, because if you cancel out, for example, let's just say we only want the PMO to have been rising for 1 day. So I'll just take these 2 out. Now let's see what happens when we run our scan. Yay, spinning beach ball of death. There you go. We got 4 more. So that's a way to go in again to maybe open up your results just a little bit. If you like your scan and maybe you're okay with maybe loosening them up a little bit, that's a way you can do that. So this particular scan, like I said, I want the 5-day EMA crossover happening. I want the PMO to be in a certain configuration, meaning rising, and then we have the 50 needs to be greater than the 200. All right, so let's go to our next one. And the next one I'm going to look at are my general and my focused PMO scans. These I've printed up. I don't even know how many blogs I've put these in. I've even put them in some of the recaps, this particular scan. Decision Point followers, I know you guys pretty much all have this scan already, but those of you don't, here's one of my favorites. This one is generalized, and I say generalized because it only is looking at stocks in the US and greater than $10, and that's it. So when I do a focused PMO scan, it's pretty much the same one, only I focus it down into a particular sector or industry group. And, after what Tom was looking at, I think there was even a question about, how you scan. This is a way that you can go into maybe a hot industry group that is looking good, or a hot sector, and you can, focus it down and then have your same requirements. And so right now, just the scan, the last thing I checked was cyclicals or in communication services. Ors are very important, okay? Ands kind of shrink your, they make your requirements more strict. And or actually opens it up a little bit. For example, you couldn't have an and here because it can't be in cyclicals and be in comm services. So you want the or, because now you're looking at both of these industry groups. So just remember that when you add ors, that you're actually opening up the group of what you're seeing. For example, in this case, you're opening it up to more sectors or more industry groups. And the way you add those industry groups, all right, I think it is when, yes, we go in here and you can pick, let's see, not this one. Right there, sectors and industries. So this is how you can add it. So for example, maybe I want to add staples in there. So I just click that and I push add, and it comes in at the bottom, but I want it at the top because that way I can see it. And notice, of course, it defaults to an and. Well, I know I need it to be an or, so I'm going to add or. So we focused it down just to those particular sectors. And again, this is the exact same scan I just showed you. Pretty sure it's absolute. I think it's the exact one. I think the only thing this one doesn't include is the scooter. And that's honestly something, that's usually the first thing I comment out. If I don't get enough results, I go ahead and let the scooter be, whatever. So in this case, I focused it down. So I didn't really want to add the scooter in there because I would probably not get all the results that I would like. So I'll just run it really quickly, and then we'll look at 2 more scans and finish it up. So you can see we had 2 results on this focused scan. I actually remember this one coming up on Monday setups yesterday, so it's still considered a good one. And Yandex, so interesting. Okay, so those were my general and focus scans. And again, I'm going to put all of these in the Market Watchers Live recap. Bottom feeders. And I run this before we do that segment. All right, and it's again very similar, very similar. Just a difference in what the PMO maybe is looking like. I think the biggest one is right here. I'm looking for a particular trend model configuration. I want to see that everything else, the 20s below the 50, the 50s below the 200, so that's bearish. You know, these two things are rather bearish. And this is a bottom feeder, so I want the setup, I want it to be a bear market configuration. I want the 20 to be below the 50. But I want to see a pop. I want to see the 5-day EMA has crossed over the 20. And then there you go. I have the scooter in the hot zone. I'll run this just to see what happens. And 0. So like I said, the best thing to do is start commenting out things that you can do without. So maybe I'll just say it's okay if the 50 is above the 200. Nope, still don't have any results. So it's just, yeah, it's a matter of just commenting out until you get some results you like. All right, and then my last scan that I'm going to show you is the momentum sleepers. And this one, it looks a little weird because I have a different configuration for the PMO, and mainly because I actually stole this from the predefined scans, but it had the MACD in it. And so I liked the way I was getting results, but I liked my PMO. And I decided I'd go ahead and use the MACD setup, defaults. And so this is one of the scans I like to look at to find my momentum sleepers. And there you go. We did get 10 that came up. So that's pretty much all I was going to show you as far as my scans go. I do have certainly more. I have a lot of fun with scans. I have my scan for dogs. I have a lot of short-term and long-term trend model scans. So I have fun with them, but I don't have a plethora that just are confusing, because I can take one of those others, like I said, and then I can comment out things. And that way it'll, it just helps me open the universe a little bit on my scan. So I can just start with the one I want, and then I just sort of manipulate it from there. So that is technical scans. They're the ones that I went over. And again, all of these will be in the Market Watchers Live recap. You can just go in and copy and paste the scan language into your own. So have fun with them. All right, Tom, time to end the show. My goodness.
Yes, it is. Great job on the technical scans. And again, Erin's going to put those into the Market Watchers Live blog later, so you can go back and take a look at that. I can pull up real quickly and just show you that currently we've got the Dow Jones Industrial Average up about 1.5 points, the NASDAQ up 8.5, the S&P down 1.5, and the Russell down 2. So it's really been mostly a flat day, not really seeing which way the market wants to go. It's not playing its hand at all right now, Erin.
No, it really isn't. Like I said, I think best case is sideways. And, we're almost doing that right now, just below that area you were talking about. So, we'll see. Are we going to just consolidate sideways? I mean, I can't argue with the charts. You just, you know what I mean? I can say, well, I feel like a bear, but you know what? I can't argue with my indicators and my charts. So, if they're proving me to be not right, I just have to go with it.
Yep. We got most of the sectors there, as you could see, was actually kind of even back and forth. So anyhow, interesting schedule coming up, as you can see on your screen. Want to thank everybody for being with us today. Please remember to complete the survey as you exit. I'd like to hear what you thought of the workshop today. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everyone. We'll see you back here tomorrow. Happy trading.